In this video, I'll introduce you to expected returns, portfolio returns, and asset and portfolio risk. So how are we going to do this? Well, I'll start by showing you how to calculate expected return. Then I'll discuss risk, and then finally I'll discuss portfolio returns and the benefits of portfolio diversification. So let's talk about how we calculate returns. The return is the percentage change in the price or value of an asset over a period of time. We take the end price or value, subtract the starting price or value, and then divide by the starting price or value. Let's look at a very quick example. In this example, Tesla's share price was $32 in November of 2012. Tesla announced earnings above what investors expected. This caused the share price to rise to $128 by August of 2013. What was the return on Tesla stock over this period? Well, to solve this, we just take the price at the end of the period, subtract the price at the beginning of the period, and divide by the price at the beginning of the period. The result is a return of 300%. Now, this is actually a real-world example, so you might be wondering, why was the return so high for Tesla over this period? Well, there's a fairly straightforward answer. We often assume that markets are efficient. This means that we assume that assets are priced appropriately, usually using the discounted cash flows method or some other method. Why? Well, if we have a large number of investors and stock analysts attempting to value a stock, then we assume that they will generally price it accurately based upon the expected cash flows and the risk of that stock. If there's even one investor who believes that stock is undervalued, they're going to buy that stock. If there's a large number of investors buying that stock, individuals who own the stock are going to require a higher price to sell that stock. The price of the stock will move until it's viewed as appropriately priced by the market. The market's going to take into account the future growth rate of the firm's cash flows, how likely the firm is to declare bankruptcy, the corporate governance, meaning how well the firm is overseen by its directors and management, and the risk of the firm's products becoming obsolete. And there's a number of other factors that are going into to determine the price of the stock. The end result is that new information about the firm can be reasonably expected to adjust the discounted expected future cash flows of the stock. If there's value-relevant information, it's going to cause investors to update their expectations, and we should see an update in the price of that stock. And that's exactly what happened to Tesla over this period. We can also calculate expected stock returns. One of the ways we can do this is by assessing the returns of a stock or another asset and then estimating the probability of that return state occurring. Then we take the product of the probability and the return, and then finally we sum up all of these products. The result is your expected return. Let's take a look at an example. In this example, we know that Apple stock will offer different returns in different states of the economy. A 15% return in a bull market or a good market, a negative 3% return in a bear market or a depressed market or a bad market, and a negative 10% return in a financial crisis. Note the probability of each of these states of the economy occurring. What you're looking at right now is a probability distribution. Now, let's multiply our probabilities by the returns and then sum them up. Our expected return in this example is 0.053 or 5.3%. Now let's take a look at another example. Let's walk through this additional example. To solve this example, I am going to go ahead and use Excel so we can actually see how to solve something like this much faster than we could by hand. So I'm going to switch over to Excel right now. And here we have our probabilities and our expected returns. Now, to calculate the expected stock return, or the expected return on Google stock, first thing we're going to do, since we've already got our probabilities and our returns, is take the products of each of these probabilities times returns. So I'm going to go ahead and do that. So equals 0.35 times -10, and I'm going to copy this formula down by clicking on the bottom right-hand corner of the cell and dragging it down. Now, our expected return on this stock is going to be calculated as the sum of all of these products. And so once I do that, I find that the expected return on this stock is about 6.4%. So that's how we do it. So now we have a sense of one method for calculating expected returns. Now let's change it up and talk about the returns for some well-known trading strategies. The first strategy we have is a strategy of investing in risky stocks rather than less risky stocks. What we know is that risky stocks outperform less risky stocks over the long run. And when I say they outperform, I mean they have higher returns over the long run. It's important to note that the risk we're using here is a special type of risk called market or systematic risk. We also know that small stocks outperform large stocks historically. We measure stock size by the market cap of each stock, so number of shares times the share price. Next, it's well known that value stocks historically have outperformed growth stocks. We define value stocks as stocks with a low market share price divided by a book share price. The book share price is just the price per share on a firm's balance sheet. So in other words, the total shareholders' equity divided by number of shares outstanding. The market share price is just the price of the firm's stock listed on an exchange, like the NASDAQ or the New York Stock Exchange. Growth stocks have high market-to-book ratios because investors typically bid up the price of those stocks. And these growth stocks are typically stocks like Amazon or Netflix or some other tech stock is typically considered or would be considered a growth stock. Finally, we know that firms which performed well last year will continue to perform well for the next 6 months. This is what we call the momentum anomaly. Now, let's take a look at one of these anomalies graphically. All right, so I've gone ahead and plotted the value of a dollar if it were to have been invested in 1925 all the way up through 2011 in various assets. So the red line indicates the return if you had taken that dollar and invested it in a portfolio of small cap stocks. So stocks that have a very low market cap relative to other stocks. And remember, a market cap is just number of shares outstanding times price per share. So as you can see, small cap stocks do outperform large cap stocks by a fairly significant margin. I mean, the end result after this, it's an 80-something year period, is that that $1 that you invested would be worth $15,532 if it were invested in small cap stocks, versus about $3,000 if you had invested in large cap stocks. Now, notice that if we were to have invested in just long-term government bonds, that dollar would be worth a lot less, only about $119. So as you can see here, the riskiness of the asset that we're investing in is directly related to the actual return. So these small cap stocks are typically seen as riskier than the large cap stocks and certainly more risky than the long-term government bonds. Now let's talk about something besides returns. Traditional financial theory is based on the idea that investors require higher returns to hold riskier assets. So how do we measure this risk? The answer is that we use standard deviation. So why do we do this? Well, variance and standard deviation measure the dispersion of points around a mean of a distribution. In this context, we're attempting to characterize the variability of possible future security returns around the expected return. In other words, we're trying to quantify risk and return. Variance and standard deviation measure the total risk of the possible returns. It's important to note that we're using these formulas to forecast risk or project risk of a particular stock going forward. We'll talk about how to calculate risk historically in a few minutes. All right, let's walk through a basic example using that standard deviation formula. And note here that this formula that I just introduced, this is actually our variance formula. The way we get to standard deviation is simply by taking the square root of our end result, that sigma squared that you see. So what we're looking at here is the variance formula, and the way we get to our standard deviation is just by taking the square root of that. But if we take a look at this example, you can actually see how we get our stock variance for a particular stock. So in this case, what we're going to do is we're going to start off with that exact same example that we had earlier, and we are going to take the probability times the return for each case, the recession case, the boom market case, and the tech bubble case, and that's how we get our products here. And again, we're calculating our expected stock return. Now, the reason we start off calculating our expected return is because we're going to have to take the difference or the deviation from our expected return for each case. So we're going to, in the next step, take this negative 10% return and subtract our mean. And we're going to do that for the boom market case and the tech bubble case. And that's going to give us a deviation from the mean. Next, we're going to take that deviation and square it. So we're doing that for each of these cases. And then finally, we multiply those squared deviations from the mean by the probability that those deviations occur. So our end result is that we have each of these probabilities times the squared deviations from the mean, and then all we have to do to calculate our variance is just sum up those probabilities times squared deviations from the mean. And that's exactly how we do it. And what we get is something that looks like this. So up here, I actually have the formulas, and down here, I actually have the numbers or the answers for each of those formulas. And so what you can see is that our variance in this example would be about 0.019. Our square root would just be our standard deviation would just be the square root of that. All right, let's take a look at another example. And this example, I'm actually going to work in Excel. So in this example, we have Facebook stock, and there's two possible market states that could occur, a bull market and a bear market. And the bull market occurs with 60% probability, and bear market occurs with 40% probability. Return in the bull market for Facebook is expected to be 20% and negative 5% in a bear market. So what I'm going to do is I'm going to calculate the variance and the standard deviation of Facebook stock, given this information. So I'm going to go over to Excel, and I'm going to work this problem. All right, so I'm in Excel, and here's our example. Step 1, we're going to calculate the expected return on this stock, this Facebook stock. So I'm going to first multiply our probabilities times the returns. Next, I'm going to calculate the deviation in each case from the mean. Next, I'm going to calculate the squared deviations from the mean by just squaring each of those deviations. And I'll copy this formula down. And finally, I'm going to calculate the probability of each case occurring times those squared deviations from the mean. All right, so that's that. The final steps are first to calculate the variance by summing all of this up, these probabilities times squared deviations from the mean, and then squaring that, or taking the square root of that. So equals SQRT. And now we have our standard deviation, which is exactly what I listed on that slide a few moments ago. So this standard deviation, this is our primary measure of total risk of an asset. This is the measure of volatility in finance. I mean, anytime you hear the term volatility, usually this is what they're referring to, just standard deviation of a given asset. So now we know how to measure risk. Let's talk about how we minimize risk while keeping returns as high as we can. The simple way we do this is by finding assets that complement each other. For example, if our portfolio only consists of Facebook stock and we want to reduce the risk of our total portfolio, we would want to find a stock that offers high returns when Facebook offers low returns, and vice versa. You've probably heard of a portfolio before watching this video, but I'll just define it here. A portfolio is a collection of assets such as stocks and bonds held by an investor. Portfolios can be described by the percentage of the total funds held in each asset or each asset class. These percentages are typically referred to as the portfolio weights. The expected return on a portfolio is the sum of the product of the expected returns on the individual securities and their portfolio weights. So what we do is we let WJ in this formula be the portfolio weight for asset J, and we're going to multiply that by the expected return on stock J, so E times the quantity of R sub J, and we're just multiplying the weights times the expected returns and then summing up all of those weights times expected returns, and that's going to give us our expected portfolio return. Let's take a look at an example of portfolio diversification. In this example, we have two stocks, ExxonMobil and United Airlines. Exxon is obviously an oil company and makes money when the price of oil is high. United is an airline, and one of its most expensive inputs is jet fuel. So United's profits are adversely affected by a higher price of oil. Now, if we build an equal weighted portfolio of these two stocks, we can keep the returns high while reducing the variation in the returns through different states of the economy. In other words, though our returns are lower with the addition of the airline stock, if outcome 1 occurs, our portfolio exhibits no return difference across different states of the economy. Essentially, it's risk-free. Regardless of which state of the economy occurs, our portfolio is going to offer us a 7.5% return. We essentially have no risk here. In the last example, we had equal weighting, or an equally weighted portfolio. Sometimes that occurs, but more often, the assets in your portfolio represent different weights. The next example is the latter case. So let's go through it. So in this example, I have 4 stocks, and they all have different portfolio weights. So Ford stock represents 20% of the total assets in your portfolio. You hold 30% of your portfolio in Apple, and then the same for Wells Fargo and Google, 25% each. And we have our expected returns. Let's calculate our expected return on this overall portfolio. So the way I'm going to do that is I'm going to flip over to Excel. And I'm going to zoom in. And the way we calculate our portfolio return is very similar to the way we calculated our expected stock return. First, we're going to multiply our weight times our expected return, and for each case, and then we're going to sum it up. So first things first, weight of the stock, and try not to mess up the formula. And I'm going to copy this formula all the way down by clicking in the bottom right-hand corner, and let's get our expected return on this portfolio. So we're going to sum up all of these products, and that'll give us our expected return on the portfolio of 9.6%. There we go. Now, unlike expected return, the variance of a portfolio is not the weighted sum of the individual security variances. What we're actually looking for, or rather what we're going to look at right now, is the formula for calculating the portfolio variance, where our portfolio consists of 2 stocks, stocks 1 and 2. So when we calculate portfolio risk, typically this is going to be the formula that we use to calculate the overall or total risk of the overall portfolio. And so what we have here are the returns on stocks 1 and 2. And to get our variance of our portfolio, we're going to take the weight of stock 1, square it, and then multiply it by the variance of stock 1, add to that the weight of stock 2 squared times the variance of stock 2, and add to that 2 times the weight of stock 1 times the weight of stock 2 times the variance of stocks 1 and 2 times the correlation between stocks 1 and 2. Now, I've mentioned that combining securities into portfolios can reduce the total variability of the portfolio return. And you might be wondering how that is, or how that can be done. And the answer is fairly simple. The answer is the correlation coefficient is going to affect the portfolio variance, or what we're more focused on is typically the portfolio standard deviation. Now, when two assets have less than perfect correlation with one another, the correlation coefficient is going to be less than 1. When this happens, the combination allows an investor to reduce risk, particularly if the correlation between the two assets is negative, like in our example between Exxon and United. In that example, the correlation was equal to -1, which means that those two assets were perfectly negatively correlated with one another. Now, it's time to talk about the two types of risk a stock carries. Every stock on an exchange can have its risk decomposed into two different types of risk. The first is systematic or market risk. This is the risk that every firm, every stock, every asset faces in the economy. It's the risk that something happens that affects the entire economy, which would expose every stock to negative returns. An example of this would be a hurricane that hits the entire eastern seaboard. The reason this would be an example of a systematic risk event would be because even if a company wasn't headquartered on the eastern seaboard of the US, chances are their suppliers or some of their buyers might be located on the eastern coast of the US. So they're going to be affected one way or another. Another example might be a financial crisis. Now, we sometimes refer to this systematic risk as non-diversifiable risk because, as you'll see in a few minutes, you can't get rid of this risk by simply diversifying your portfolio across a number of different stocks. The other type of risk is called firm-specific risk or unsystematic risk. This risk is the risk that we are eliminating when we diversify our portfolio across a number of different stocks. It's the risk that is only present in one particular firm. When we diversify our portfolio across several stocks, rather than just holding one stock, we reduce our exposure to that one stock, which means that adverse events that negatively affect that stock's price cause our portfolio to depreciate to a lesser extent because we're holding less of our portfolio in that stock. Now let's take a look at what happens when we diversify our portfolio across more and more securities. So what I have here is a very quick example. In this example, we start out with one stock in our portfolio, and its annual standard deviation is 49.24%. And we have the ratio of that stock's standard deviation divided by itself. Now, as we add another stock to that portfolio, our total portfolio standard deviation falls to 37%. And just in proportional terms, that 37.36% divided by 49.24% is 76%. So we've decreased our risk of this portfolio by about 24% by simply adding another stock to our portfolio. Now, as we add more and more stocks, what you're going to see is that our standard deviation, our total risk of our portfolio, is going to fall and fall and fall. But after a certain point, usually around 30 to 50 stocks, that fall off as we add that next stock is going to be somewhat minimized, or at least we're going to hit a limit here. And that limit is right around 19% or 0.19% in terms of standard deviation. What you're looking at is our portfolio going from a case where we're not diversified at all to a case where we're extremely diversified. And what's left here with this 19% or this 19.21% represents is primarily our systematic risk, the market risk of our portfolio, the risk that we can't diversify away. Now, if we want to put it in graphical terms, it looks something like this. So this is where we started, up here with one stock. So our y-axis is just the standard deviation of our portfolio, and the x-axis is the number of stocks in our portfolio. And as you can see, as we add more and more stocks, the total standard deviation of our portfolio, meaning the total risk of our portfolio, decreases to a limit, and that limit's right around 19.1%. But anything lower is not going to be achievable because we can't diversify away that non-diversifiable, that systematic risk. So once we're completely diversified, what's been diversified away is that diversifiable, that firm-specific risk. What's left is the non-diversifiable stuff. It's the stuff that you're never going to be able to get rid of if you're holding stocks in your portfolio. Now, a couple final points, or I guess one final point I need to mention is that when a mutual fund or some other fund, like an ETF, or, I mean, we'll stick with a mutual fund, but typically we say that a mutual fund is fully diversified or well diversified when it holds about 20 to 50 different assets. So those could be stocks, or those could be stocks and bonds, or some other assets in their portfolio. But usually once we get to about 20 to about 50 stocks, that portfolio is about as well diversified as it's going to get. Now, let's summarize what we just talked about. First, expected returns of stocks and portfolios are dependent upon the probability of each return state occurring. Next, we showed that total risk is usually measured using standard deviation. Third, we saw that portfolios can be diversified by holding assets with low correlation coefficients with each other. And then finally, we saw that firm-specific risk can be diversified away, but systematic risk can't be diversified away. So I'll continue my discussion of returns and risk in my next video.